15 California cities are experiencing notable housing price declines in 2026, driven by a combination of mortgage affordability challenges, wildfire insurance market disruptions, condo carrying cost increases, and the normalization of remote work patterns that had temporarily expanded buyer pools in specific markets. Before we dive into the cities, I need to be extremely clear about something. Nothing in this video is financial, real estate, or investment advice. I am not a licensed financial advisor, real estate agent, or market economist. What I'm providing here is analysis and commentary on publicly available housing price data from sources including Zillow, Redfin, Realtor.com, and other market trackers, along with insurance market information and economic data. Price data changes frequently, individual property values vary substantially from market averages, and small sample sizes in some markets can create significant month-to-month volatility. You are solely responsible for your own real estate and financial decisions. If you're considering buying or selling property in any California market, work with licensed professionals including local real estate agents, financial advisors, and insurance specialists who understand current conditions in your specific area. This is educational content only. Alright, let's start with number 15, Los Angeles. Los Angeles is the mildest case on this list, and that's exactly why it sits at number 15. But something is happening here worth understanding. Over recent months, median home prices in Los Angeles slipped approximately 2% year over year, sitting around $1 million. 2% on $1 million home represents $20,000 in value adjustment in a market that appreciated for decades. The more meaningful signals are underneath that headline number. Homes are taking approximately 50 days to sell, and transaction volumes have declined. Softness is concentrated in two segments: the condo market, particularly downtown and mid-tier units, and the luxury end where high-earning buyers have become more cautious. Mortgage rates above 6.5% combined with insurance premium increases in hillside and fire zone areas changed affordability mathematics for many buyers. This isn't collapse. This is a market where buyer willingness to pay any price regardless of affordability reached its limits. Number 14, Victorville. Victorville in San Bernardino County sits approximately 90 minutes north of Los Angeles along Interstate 15. The headline median sale price around $427,000 appears relatively stable. But price per square foot is down approximately 10% year over year. That divergence indicates buyers are purchasing smaller properties or negotiating substantially lower prices for comparable space. The metric telling the clearest story is that roughly 1 in 3 homes listed in Victorville has had a price reduction. More than 30% of sellers listed waited without acceptable offers and reduced asking price. Victorville was built on the premise that families priced out of Los Angeles could afford homes with yards by accepting long commutes. When mortgage rates climbed above 6.5%, monthly payments crossed affordability thresholds for the buyer pool this market depends on. Inventory accumulated. Days on market extended. Sellers who purchased during appreciation period now compete with each other for a reduced buyer pool. Number 13, San Bernardino. San Bernardino County as a whole shows median sale prices down approximately 3% year over year, sitting around $535,000. Price per square foot declined a similar amount and transaction volumes dropped. For one of Southern California's largest counties to be sliding while other state markets set records indicates meaningful underlying pressure. San Bernardino County spent decades as the affordability answer to Los Angeles and Orange County. When coastal markets priced out buyers, they moved inland and the Inland Empire appreciated substantially. But the same factors affecting other markets hit here significantly. Mortgage payments increased with rates above 6.5%. Insurance costs climbed in foothill and wildfire zones surrounding the county. Local wages never kept pace with how rapidly prices escalated during appreciation period. The result is more inventory, extended listing periods, and negotiating room for buyers that didn't exist during peak conditions. Number 12, Palm Desert. Palm Desert is one of the Coachella Valley's premier resort communities, longtime favorite for retirees and seasonal residents. Typical home values are down approximately 3% over past year, sitting in mid-500,000s. The more telling indicator is time on market. Homes in Palm Desert are taking approximately 77 days to sell, well over 2 months, and the local market has shifted to buyers' market conditions. Palm Desert is built around second homes, golf course communities, and seasonal residents spending winters in the desert. That makes it particularly sensitive to two factors: interest rates and economic confidence. When borrowing costs are elevated, discretionary second home purchases are what buyers delay first. When broader economic conditions feel uncertain, the seasonal buyer waits. HOA dues and insurance premiums across the valley have increased, adding to monthly ownership costs. Sellers expecting typical seasonal demand are finding listings sitting longer than anticipated. Number 11, Concord. Concord in central Contra Costa County sits approximately 30 miles east of San Francisco and represents a Bay Area pattern worth examining. While San Francisco proper and peninsula markets are appreciating in 2026, East Bay inland markets like Concord are showing different patterns. Broader East Bay prices are down approximately 2.5% year-over-year. Looking specifically at existing single-family homes in Contra Costa County, the median declined closer to 6%. Home sales in Concord dropped approximately 13% compared to prior year. Transaction volume decline is often a leading indicator of price direction. From February to March alone, during what should have been strengthening spring market, average prices declined rather than increased. Remote work pattern changes contributed substantially. Buyers who relocated to Concord during pandemic period either returned to locations closer to employment or the demand they represented dissipated as those who remained faced actual commute requirements. When buyer pools contract, prices don't always adjust immediately. They bleed slowly as sellers gradually accept that anticipated offers aren't materializing. Number 10, Desert Hot Springs. Desert Hot Springs sits just north of Palm Springs and has historically been the more affordable Coachella Valley entry point. The headline single-family home value is nearly flat, down less than 1%. But the condominium and attached home market tells a dramatically different story. Condo values in Desert Hot Springs declined more than 21% in a single year. This is the same dynamic appearing across desert markets and broader Sunbelt areas. Condos were overbuilt during appreciation period. Then HOA dues increased, insurance premiums increased, and special assessments arrived. The total monthly carrying cost of an apparently affordable desert condo increased substantially beyond what the purchase price suggested. Buyers who calculated true monthly costs, including HOA fees, insurance, taxes, and potential special assessments, found the value proposition weaker than surface prices implied. Desert Hot Springs attracted the most price-sensitive buyers precisely because of its relative affordability. Those buyers are also most vulnerable to carrying cost increases. Single-family homes are holding relatively stable while the condo market has corrected substantially. Number 9, Moreno Valley. Moreno Valley in Riverside County has population around 210,000 and expanded substantially over the past decade, driven significantly by logistics industry growth. Massive distribution centers created employment that attracted entry-level buyers seeking the most affordable new construction within reasonable employment access. Median home prices are down approximately 3% year-over-year, sitting around $556,000. Approximately 1 in 3 homes listed in Moreno Valley has had an asking price reduction. Moreno Valley has historically been a first-time buyer market, and first-time buyers are most sensitive to interest rate changes. When rates exceeded 6.5%, monthly payments on entry-level homes increased by hundreds of dollars. Young families who were the primary buyer pool found qualification increasingly difficult. Inventory accumulated. Listing periods extended past 2 months. Sellers who purchased near appreciation peak with minimal equity are reducing prices into a market with fewer qualified buyers. Number 8, Lancaster. Lancaster in Antelope Valley sits approximately 70 miles north of Los Angeles. During appreciation period, builders expanded new subdivisions rapidly across the valley in anticipation of sustained buyer demand from people priced out of Los Angeles. Typical home values are down approximately 4% year over year, sitting in mid-400,000s. The clearest signal is days on market. Listings in Lancaster are sitting over 100 days on average. When properties take 100 days to sell, sellers face limited options, price reductions or withdrawal from market. Most ultimately reduce prices. Lancaster's value proposition has always been affordability combined with space. That proposition works when both mortgage payments and commute costs pencil out for buyers. With elevated rates and fuel costs, the mathematics became more challenging. New construction that was intended to signal growth now represents additional competition for existing home sellers. Number 7, Palmdale. Palmdale sits adjacent to Lancaster in Antelope Valley. The median home price declined more than 5% over past year, down to approximately $512,000. That represents one of the steeper percentage declines on this list. Palmdale has legitimate economic anchors. Aerospace and defense manufacturing, including advanced aircraft production at local facilities, provides substantial stable employment. This isn't an industry collapse story. This is an affordability mathematics story. Palmdale grew because it represented the outer edge of commutable distance from Los Angeles, where working families could purchase new homes at accessible prices. That model depends on two cost factors remaining manageable: mortgage payments and commute costs. When rates climbed above 6.5%, monthly payments increased by hundreds of dollars for buyers already stretching financially. Buyers who were at affordability limits couldn't absorb additional payment requirements. Demand decreased, listings accumulated, and prices started declining. The aerospace employment base provides a floor preventing more severe deterioration, but 5% annual decline indicates the price got ahead of what local buyers can sustain. Number 6, Salinas. Salinas in Monterey County sits in the heart of California's agricultural production region. The area produces substantial portions of American lettuce, strawberries, and vegetables. Median home prices around $700,000 declined approximately 5% year over year. The fundamental disconnect is between who actually lives and works in Salinas and what homes cost. This is an agricultural economy. Local wages reflect agricultural employment levels while home prices approached coastal California levels. That gap existed for years and was bridged by buyers from the Bay Area and Monterey Peninsula seeking relatively more affordable options. When mortgage rates elevated and broader Bay Area markets cooled, that overflow of outside buyers declined substantially. Without outside buyer support, local incomes determine the sustainable price level. Agricultural wages don't support $700,000 median homes. Prices are giving back ground as the market adjusts toward levels local buyers can actually support. Number 5, Merced. Merced County shows median home prices down approximately 9% over past year, sitting around $400,000. The city of Merced itself is holding somewhat better than counties surrounding it. Merced represents the far edge of Bay Area economic reach, historically the most affordable gateway into Central Valley for buyers priced out of San Jose and East Bay. The market was hit from two directions simultaneously. Local Merced buyers earn Central Valley wages that are among California's lower income levels. Higher monthly payments due to elevated rates reduced affordability for this primary local buyer pool significantly. Simultaneously, Bay Area buyers who previously drove prices up through relocation demand reduced that activity as their own market considerations changed and commute requirements from Merced to Bay Area employment became less attractive. Removing both primary buyer pools simultaneously created the conditions the data shows. Declines approaching 9% while broader California headline numbers suggest strength. Sellers are reducing prices. Listing periods are extending. Equity that accumulated during appreciation period is declining. Number 4, Palm Springs. Palm Springs is the Coachella Valley's most famous community, mid-century celebrity destination, and resort market that has attracted buyers for 7 decades. In 2026, it has shifted to buyers' market conditions. Price data varies by source. Detached home values are down anywhere from a few percent to over 8% depending on tracking methodology, with median prices between $1 and $1.2 million. The condominium market shows clearer decline of approximately 6%. The Palm Springs situation has a specific cause beyond general affordability challenges: short-term rental regulation changes. For years, a significant portion of Palm Springs' demand came from investors purchasing properties specifically for short-term vacation rental income. The investment mathematics justified premium prices because rental income offset ownership costs. Then Palm Springs implemented stricter limits on annual short-term rental days. The investment case for purchasing changed overnight as potential rental income declined substantially. Investor demand that had been supporting prices decreased. Add elevated mortgage rates and insurance cost increases, and the remaining discretionary second home buyer became more cautious. Properties that sold quickly during peak period are now sitting through negotiation processes while sellers adjust to market that has clearly shifted. Number 3. Indio. Indio is the largest everyday residential community in the Coachella Valley, where Coachella and Stagecoach music festivals happen annually, but most residents are simply going about normal life. Condominium and attached home values in Indio declined more than 10% in the past year. Measured from 2022 peak, condo values are down approximately 20%, representing $1 in 5 of value lost. Single-family homes are holding substantially better. This is primarily a condo story, and it's a significant one. The same dynamics appearing across desert markets are concentrated here. Condos were overbuilt during appreciation period. Subsequently, HOA dues increased, insurance premiums increased, and special assessments created surprise financial obligations for owners. Condos that appeared affordable based on purchase price became substantially more expensive when true monthly carrying costs were calculated. Buyers recognized this and reduced purchase activity. Because Indio serves as the entry-level and middle-income buyer gateway to the valley, price corrections land hardest on the most financially sensitive buyers and owners. 20% off peak values isn't modest adjustment. That's meaningful correction affecting real financial positions for people who purchased at or near peak. Number 2. Clear Lake. Clear Lake in Lake County sits on the shore of California's largest natural lake entirely within state borders, approximately 2 hours north of San Francisco. This is the smallest and most distressed market on this list by significant margin. Typical home values around $220,000, down approximately 6.5% year-over-year. In individual monthly data, median sales prices have swung dramatically, with one recent month showing median around $195,000 compared to $288,000 the prior year period, though small sample sizes create significant monthly volatility. Homes are selling at approximately 82% of asking price on average, meaning sellers are accepting roughly 18% below their listed price. Over 9 months of unsold inventory sits on the market. Listing periods range from 3 to nearly 6 months. The cause is clear: fire and insurance. Lake County experienced repeated significant wildfires over the past decade. Nearly all properties in the county carry wildfire risk designations according to available data. Insurance carriers have withdrawn from the market extensively. Obtaining affordable conventional insurance has become extremely difficult and in some cases impossible. A property that cannot be insured cannot be purchased with a conventional mortgage. When financing is unavailable or insurance costs make total ownership economics prohibitive, market liquidity collapses. Clear Lake illustrates what happens when insurance market challenges become severe enough to essentially freeze transaction activity. And number 1. Oakland. Oakland in Alameda County has population around 440,000, sitting across San Francisco Bay from San Francisco and representing the third largest Bay Area city. By available data, Oakland shows among the steepest home price declines of any large American city in 2026. Typical Oakland home values declined approximately 11% in the past year adjusted for inflation. From 2022 peak around $1.1 million to current levels around $716,000 represents roughly 35% peak-to-trough decline. Current values are at levels last seen approximately a decade ago, meaning years of appreciation have reversed. 3 factors combined to create these conditions. First, remote work pattern changes. Oakland appreciated substantially during 2010s because it offered relatively more affordable alternative to San Francisco while providing reasonable commute access. When office attendance became less mandatory during pandemic, that commute premium disappeared. Buyers who might have paid Oakland prices for San Francisco job access proximity found less reason to do so. Second, downtown and commercial challenges. Oakland's downtown and condo-heavy neighborhoods experienced significant difficulties. Office vacancy rates climbed substantially. Retail closures increased. Public safety concerns affected buyer confidence in urban core neighborhoods. Third, affordability mathematics. Even after substantial price declines, monthly mortgage payments on mid-priced Oakland homes remain significant at current interest rates. The price needed to fall substantially before affordability mathematics worked for remaining buyer pool. Important nuance: Oakland's experience varies significantly by neighborhood. Wealthier hill neighborhoods including Rockridge and Temescal are performing substantially better, still generating competitive offers. The downtown core, flatland neighborhoods, and condominium market are experiencing the most significant declines. The aggregate number reflects the whole city average but masks this geographic variation. So those are 15 California cities experiencing housing price declines in 2026. 3 factors appear repeatedly across these markets. First, affordability mathematics changed. With mortgage rates above 6.5%, monthly payments that were barely manageable at lower rates became unworkable for significant portions of buyer pools. Second, buyer pools contracted. Remote workers returning to employment centers, Bay Area overflow buyers reducing relocation activity, and investor demand decreasing left markets dependent on those buyers with insufficient demand to sustain pandemic-era prices. Third, total ownership costs increased beyond mortgage payments. Wildfire insurance tripling or becoming unavailable in some counties. Condo owners facing HOA increases and special assessments. Property taxes on appreciated values. These costs converted apparently affordable properties into financially challenging positions. The critical context is that California is not one housing market. It is hundreds of distinct local markets responding to local economic conditions, employment patterns, insurance availability, and buyer demographics. Many California markets are appreciating in 2026. Coastal job centers, markets with strong local economic bases, and areas without significant insurance challenges are performing differently than the communities described here. Understanding which specific factors affect any market you're considering matters far more than statewide headline statistics. For potential buyers in declining markets, current conditions offer negotiating leverage not present during peak periods. But reduced prices alone don't guarantee value if underlying challenges persist. Insurance availability and cost, local employment fundamentals, HOA financial health in condo markets, and realistic assessment of what's driving the decline all matter for evaluating whether current prices represent genuine opportunity or further adjustment ahead. For current homeowners in these markets, understanding the specific factors affecting your community helps contextualize current conditions and inform decisions about timing and strategy if selling is a consideration. That's the breakdown of 15 California cities experiencing price declines and the specific factors driving each market's adjustment. Thanks for watching. If you found this analysis helpful, let me know in the comments. Tell me which market surprised you most or share what you're seeing in your own area. And if you want more content breaking down California housing markets with careful analysis and no sensationalism, subscribe to the channel. I'll see you in the next one.